Hello, good morning to all, and I hope that you guys have a great weekend ahead. And I'm Kelvin here again, the senior market analyst of OANDA Asia Pacific. So very good morning. Welcome to today's daily dose of market insights. Today will be Monday, the 18th of March, 2024. So before we start our daily dose of market insights, let's take a look at the disclaimers first. Yep, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook for today, I'd like to share with you all what has taken shape last Friday, which that means i.e. During the European and the US session, and as well as what happened overnight in the weekend, as well as today early morning, before we jump straight into our short, we call it daily dose of insights today. So what happened weekend over here is that on Friday, we see a lot of very mixed performance across the board in terms of the risk on, risk off behavior. Why do I say that? Because the European stock indices, taking the German 30, which is the DAX as a proxy, continue to be rather resilient, i.e. they continue very firm above their short-term pivotal support level at around the 17,100 level. Later I'll share with the short-term technical outlook. Very clearly, the short-term uptrend still remains intact, but however, a very whipsaw behavior among the major US stock indices. Why? Because we see a bit of jittery movement on the US 10-year Treasury yield that is going to inch higher above the this 200-day moving average. So let me share with you the movement of the 10-year US Treasury yield first before I jump straight into the movement of the benchmark. How does it impact the US benchmark stock indices? Okay, so as you could see my screen over here, this is the US 10-year Treasury yield. So the US 10-year Treasury yield, what we could see at this juncture, it continues to be rather strong move in the last 4 days. So what we could see is that after breaking past the 200-day moving average on Thursday and last Friday, it added on 2 basis point increase. So right now it's actually hovering right below the lower limit of that 4.33% major range resistance. So this major range resistance is between 4.33% and 4.5%. And if you look at the hourly RSI over here, not hourly RSI, pardon me, the daily RSI. Okay, so right now it's attempting to test this significant parallel resistance as well. So what we could see is that if we start to see a bit of breakthrough above the 4.33%, the next resistance level will be the upper limit at 4.5%. So if this case scenario were to take shape, it actually potentially could actually lead to a negative feedback loop impact on the major US stock indices. Why? Because it's telling us that the longer term cost of funding has started to be inching up on the upside as well again. Okay, so what we could see is that on Friday, the worst hit market were the Nasdaq 100, which is down negative 1.15%, and for the week it ended 1.17%, and the SPX down negative 0.65%. For the week it ended negative 0.13%. And even the Dow Jones Industrial Average also continued to inch lower on last Friday, negative 0.49%. For the week, almost unchanged. One thing positive is the Russell 2000. The Russell 2000 added 0.4% on Friday, but however, for the entire week of last week, it was the worst performer, down negative 2.08%. This is due to the fact of this ongoing rising 10-year US Treasury yield. That's also has a very strong negative performance have a very strong inverse correlationship with the US, with the Russell 2000. Why? Because the Russell 2000 companies tends to have weaker balance sheet. That means, i.e., they require a cost of funding to maintain their business operation. So if you look at the heat map of the S&P 500 on last Friday, this was last Friday intraday heat map. So it ended the US session. So what we could see is that the main culprit is the Mega 7 cap component stocks. So what's the Mega cap component stocks? It actually tells us the mega cap technology space, including of Tesla. So what we could see over here is that Microsoft was down negative 2%, Apple down negative 0.22%, then with the likes of Google, Meta, Amazon as well. And Nvidia closed down slightly negative 1.2%, but it doesn't bow well to the entire semiconductor space, which is quite mixed at this juncture on last Friday. So, but however, if you were to look at the price action, okay, so if you look at the price action as a better, taking a look at a better, we call it a perspective of how the market moved from a weekly. So let's look at the weekly price action. So if you look at the weekly price action on the SPX 500, okay, what we could see is that we see two not so rosy sign. Okay, so we see a spinning top on the prior week of 4th of March, and we see a bearish shooting star on the week of 11th of March last week. So given these two lackluster candlestick pattern, it seems to us that this push up here from the start of this year in January is due for some signs of consolidation or minor corrective pullback, at least from a multi-day to multi-week perspective, by the appearance of these two bearish candlestick pattern. And this candlestick pattern doesn't take in the form of a 50-minute, 5-minute daily, what is taken in the form of a weekly candlestick. So in terms of technical analysis perspective, anything that is from a higher time frame has a significant we call it a spillover impact going forward. Okay, this is what I want to stress. And very similar, if you look at from the Nasdaq 100 as well, right at the upper boundary of this major ascending channel, it starts to form a bearish candlestick follow through from last week. Bearish price action from on its weekly chart. What we could see over here. Then you have the Dow Jones Industrial Average, also at the key resistance level. It starts to actually traded sideways. And last week candle also formed a kind of a bearish, we call it shooting star formation after a retest at the major as a key resistance at around the 39,200 level, and it can't break through it. And what's interesting over here is the Russell 2000. So Russell 2000 also formed a bearish weekly candlestick follow through after the prior week, for the week of 4th of March, bearish spinning top. Then thereafter we start to form a long black candlestick body. And if you take into account these three candlesticks, is a weekly evening star, 1, 2, 3. The evening star actually formed the appearance of last week candle, right? So this is also a weekly candlestick, so a weekly bearish evening star right below resistance at 2130 level. Okay, at this mark over here. So all in all, right, what we could see, the weekly candlestick of the major US stock indices that I shared with you all right now a while ago doesn't really bode well for the bullish tone, okay, for the US market. And given the fact that we also have this ongoing risk event that is taking shape this week, which is the FOMC meeting that is going to be concluded on Wednesday, or I will say that Thursday Singapore time, because it's 20th of March US timing, 20th of March, so that will be early morning Asia session around 2 a.m. Singapore time. So no, in fact, it's later I'll do a double check again on the timing. Okay, so with that, right, that is something to be mindful of. And in terms, if I were to look at from a purely technical analysis perspective, the short-term and the medium-term uptrend on the major US stock indices seems to be at risk at this juncture. Okay, so that is for the last week movement. So last week movement on gold also came down a fair bit, given that the rise of this the US 10-year Treasury yield. So gold is down by negative 0.3%. The US dollar index slightly up by positive 0.08%, and West Texas Oil almost unchanged on last Friday. Okay, so now what are the key events that has taken shape so far? So what I'm going to share with you all is, for those who are looking at the dollar yen or the Nikkei 225 perspective, is this Japanese, you know, that the Japanese wage negotiation results, the first preliminary result has been out on last Friday, late last Friday, I would say. That means after the close of the Japanese session around 2:30 p.m., 3 p.m. Singapore time, they release it. So this one is because, you know, that Japanese, there's a lot of union group. So the largest union group called Rengo released their preliminary result on last Friday. So it was actually announced stronger than expected annual wage deals. Okay, so what they did over here is that the which the largest Japanese unions managed to actually get a good deal for their employees, pardon me. So the average annualized wage deal increase for this financial year for Japanese employees within this Rengo union is at 5.28% year on year. So that is more than, I think, 4% that was initially forecasted by the consensus, and way above last year 3.58%. And this 5.28% is the highest wage increase since 1991. Okay, so that is close to 31 years, more than 31 years of highest rate increase. So what does it translate to? So that could actually translate to giving us more, we call it evidence, that the Japanese economy has more or less slowly starts to exit out from their deflationary risk spiral scenario. Why? Because with a higher wage increase, it will lead on to higher consumer spending. Okay, higher consumer spending will lead on to what I call a much more elevated demand led or demand pull inflationary pressure going forward. So that could actually give more resolve for BOJ to actually remove their short-term interest rate policy either this week or on the next meeting in April. So this week we're talking about tomorrow, because tomorrow they will conclude their meeting. And if you look at the recent news flow over here from various Japanese local media, from Kyodo. Previously, there was one media out of another media called GG. They also speculated that they will actually leave short-term rate to 0 to 0.1%. That means they totally will scrap off their short-term negative interest rate policy on Tuesday instead of April. So there's a lot of what I call front loading of news that BOJ, there's a high chance that BOJ will move. All right, over the last two. So this is the latest news flow, indicating that, speculating that BOJ will start to remove their short-term negative interest rate on Tuesday instead of April by this Japanese new energy called Kyodo. All right, so but what's interesting over here, later I'll share with you, is that instead the dollar yen starts to actually pierce up that means the dollar yen rallied, that means yen weakness instead of yen strength ahead of this news flow. So what you could see over here, it seems to us that market participants, either two things. Someone is actually preventing the dollar yen from actually selling off ahead of the BOJ meeting, or market participant refuses to listen to this news flow. That means they do not trust the BOJ, we call it actions, as indicated by this news flow. Why? How does this news flow actually get derive their conclusion or derive this speculative conclusion? Is due to what I call from their sources in BOJ. They quoted sources from the BOJ. So either two things. Somebody in the market do not want the price action of dollar yen to actually come down. That means they do not allow dollar strength to come into play, despite the fact that this news flow is supporting yen strength. That means dollar yen weakness, or the market participant does not believe this news flow, given the fact that Bank of Japan is rather sneaky at certain point in time. That means they tend to actually surprise the market instead of going against what market is expecting them to do. Two scenario to play back. So later I'll look at the price action of the dollar yen. Pretty much interesting, given the fact that the yen is not strengthening despite this despite this news flow that is actually data that is supporting yen strength movement. Okay, and also early this morning, what we have over here is the release of China data, which is rather mixed. Why? Because industrial production, yes, increased more than expected, 7% year on year for the month of February. So this is not February, it's January and February, because they tend to look into 2 months because of the Lunar New Year holiday. So for the 2 months, you analyze it 7% year on year, above 6.8%, slightly above 6.8% in the month of December, and way above consensus of 5%. But retail sales kind of lackluster, almost in line with consensus at 5.2%, only slightly above at 5.5%, and still below the December figure of 7.4%. So if you look at so it's more like a mixed bag performance. So you look at industrial production over here, it came in at 7% year on year for these 2 months of January and February. So that was the steepest expansion since January 2022. So what I could see, you look at the trend, it's actually trending upwards as well. But if you look at the trend of the retail sales, that means consumer spending, okay, it's actually not trending upwards. It's actually still inching downwards for the month of January, and for this 2 months of January and February at 5.5% year on year. So what we could see over here is that given this mixed bag of performance in these two China economic data, we are still showing no clear signs of an exit from their deflationary risk spiral. Okay, so this is what is these two indicator, if you combine it on the net impact, is telling us on the state of the Chinese economy. All right, so with that, that pretty much sum up for what happened, has taken shape on Friday, over the weekend, and as well as currently at this moment in time in terms of economic data release and the significant news flow that I share with you all. So with that, let us now straight jump into the short-term technical outlook. Okay, so let us start with the FX market first. So over the FX market, like I mentioned earlier on, what's interesting over here from a 5-day rolling performance basis. Okay, so let me expand my screen so that you guys could see. Okay, so from a 5-day rolling, so this is a 5-day rolling performance basis. That means it's a rolling 5-day using the dollar as a base currency versus against the rest of the major pair. So what you could see, the pure outlier, right, is the dollar yen that has been way on the upside, on the outlier. That means the dollar is strengthening against the yen despite news flow and data that is supporting yen strength. So like I mentioned earlier on, the two things could happen. The market participants do not believe of what is the market has already starts to announce. That means, i.e., they don't believe that BOJ will start to really remove short-term interest rates tomorrow, and they may continue to do that flipping of neither here nor there kind of guidance again. But however, the rest of the currency, yes, we see dollar strength coming in, but after that, the dollar strength starts to go sideways on last Thursday and last Friday instead. All right, so very interesting to see how this dollar yen pair movement plays out. So with that, right, let us straight immediately jump to the dollar yen short-term technical outlook. Okay, before I jump to the other currency. So this is the dollar yen. Okay, so what you see the dollar yen over here, it actually spike up. All right, so where is spike up right now? It spike up at the top of this ascending channel. All right, this minor ascending, the upper limit of this minor ascending channel from the high from 11 of March low. And after that, this early morning Asia session, after it spike up, there's a minor profit taking, or minor, we call it, we put it away, minor inch down of the dollar yen movement. And where does it inch down? It inch down right at the upper limit of this minor ascending channel, and also right below the 20-day moving average. And bear in mind, I'm using trading view. Even though this is the hourly chart, I could overlay a higher time frame moving average on the hourly chart. And also, if I were to do a Fibo retracement, taking from the minor decline from 1st of March all the way down to 11th of March, okay, it actually stopped close to the 0.764 Fibo retracement. And what's interestingly over here, the RSI starts to show a bearish divergence finally, okay, after it's moved up in the last 1 week or so. So with that, right, I'll be watching this 149.50 as my short-term pivotal resistance that I have for today, ahead of BOJ news tomorrow. All right. So and if BOJ really starts to cut short-term negative interest rates, and they starts to turn more hawkish, it could potentially see dollar yen to actually push down further from here. Why? Because the movement of the dollar yen right now is not coming down. Instead, it's actually pushing upwards. All right, so it's a kind of a reflexive mover. And the first support to watch will be at this 108.80/60 level, which is also the 50-day moving average. So this level got to be taken out on the downside before we can see much more substantial potential down movement on the dollar yen to expose to next near-term support level at 47.95, which is this former minor swing high of 12th of November, 13th of November, and 14th November. Down turns into a pullback support and also correspond to the lower limit of this minor ascending channel. Okay. However, an hourly close above 49.50 will invalidate this bearish bias on the dollar yen to continue to see that squeeze up to expose the next intermediate resistance zone of 150.50/150.65. Okay, so that's for the dollar yen. Now moving on will be the Aussie dollar. So the Aussie dollar, the RBA will also starts to do so-called announce their monetary policy tomorrow as well. So tomorrow you see, so in fact this week we have a long list of major risk event. So it's more like a central bank risk event week for this week. So other than the Fed, we have BOJ and we also have RBA tomorrow morning at later I'll share the timing for RBA. So for the RBA side of the story, right, before we jump into the technical chart, right, I want to share with you all. So RBA, right, what market is expecting is market is expecting RBA to see keeping the tightening bias as inflation stays elevated. So what we could see is market expecting is the RBA to expect hold interest rate at 12-year high on Tuesday, as the economy shows signs of slowing further while unemployment trends higher. So the key thing over here is this RBA, they keep on concerning about external inflationary factors. And given the fact that we start to see the US CPI data and PPI data that is out 2 weeks ago that are still neither here nor there, that means they are not showing signs of softening. And if you were to look at what we could see over here is that wage growth in Australia also continue to be healthy on the upside, despite the fact that unemployment rate is ticking up and that CPI year on year is coming down. So due to a very strong wage growth environment, then also given the fact that the RBA governor will always be mindful of global inflationary trends, especially in the US, that is still not showing signs of softening, clear signs of softening. So very likely they will still maintain their interest rates at the current level, okay, and they may also continue to hint a bit of slightly hawkish biasness, and the first interest rate cut will most likely to come in the second half of this year. Nothing pretty much changed on the RBA side of the story. So if you look at from a technical perspective on the Australian dollar, so Australian dollar going to find support level at around the 200-day moving average. Okay, so that's around 65.60. So no change, right? I'll be using this 0.65 6560 65 65 give me a minute, let me do a proper one. 6560 6550 level, so 6550. Okay. Okay, so one thing positive I want to highlight is the bullish divergence that is being seen on the hourly RSI right now that is playing out. So indicating to us that the late last week down move here, the push down to retest the 200-day and the 20-day moving average as support level, that downside momentum seems to be abating at this juncture by the appearance of that bullish divergence on the hourly RSI. So using that 65.50 as my short-term pivotal support level. So this 65.50 level is also confluence with the 61.8 Fibo retracement, the golden ratio of that previous minor up move from the low of 5th of March to 8th of March. All right, so pretty much a key inflection level for the Aussie dollar. So as long as this 65.60 short-term pivotal support holds, supported by the bullish divergence that is being seen on the hourly RSI, potentially we may see a bit of minor recovery on the Aussie dollar. First resistance level to watch for sure will be the 66 figure level. Second resistance, 66.50 level. Only an hourly close below 65.50 will invalidate this short-term recovery bias scenario to expose the next near-term support level at 65.20, followed by 64.90. Okay. Now, European currency. So the European currency, let us start with the euro dollar. So for the euro dollar, what we could see over here, the euro dollar going to hold our short-term pivotal support that we highlighted on last uh, Friday, 108.90, 108.70. So for sure, no change, as it's going to shape a one thing interesting, it meant to shape a higher low right above this support level and right above the 20-day moving average as well, and also this lower limit of this minor ascending channel that has been tested as well, higher low. So given this formation of higher low right at this 1.0890 slash 1.0870 short-term pivotal support level, we will still maintain that short-term recovery bias scenario. First resistance to watch for sure will be at 1.0910, followed by 1.0970. Only an hourly close below 1.0870 will invalidate this short-term recovery bias scenario on the euro dollar to expose the next near-term support level at 1.0840, which confluence with the 200-day moving average, followed by 1.08 figure level, which is the minor swing low area of 28th of February and 1st of March. Sterling dollar. So sterling dollar move very closely with the euro dollar hand in hand. So this one over here, it didn't shape a higher low, but what's interesting over here is that the RSI now shape a higher low. All right, so I could see this is a bullish divergence as well, indicating to us that last Friday push down in terms of downside momentum has abated as well. So no change, 1.27 figure short-term pivotal support level that we have on last Friday. We also confluence with this upward sloping 20-day moving average as well very closely. So as long as this 127 figure short-term pivotal support holds, we will still maintain that potential short-term recovery bias scenario. First resistance level to watch 1.2760, followed by the next resistance at 1.2820. Only hourly close below 1.27 figure level will invalidate this short-term recovery scenario to expose the next near-term support level at 12670, which confluence with the lower this minor ascending trend line that I drew for 14th of February. Below 1.2670 exposes the 126 figure support level, which confluence with the 200-day moving average as well. All right, so net overall, what we could see over here is the last 2 days of dollar strength may start to show a bit of mean reversion. That means dollar strength dissipating based on the short-term technical elements of the various dollar pair that I shared with you earlier on. Okay, now let's move to the major indices, major stock indices. Start from the Asia side of the story. So from the Asia story, let us look at the Hong Kong 33 over here. So the Hong Kong 33, which is the Hang Seng Index, managed to help. Okay, last Friday we turned neutral between 16,890 and 16,480. So what's interesting over here is that right now it managed to form a bullish hammer formation right at the 20-day moving average. All right, in the last 2 hours ago at the start of the Asia session. So with that positive element that has been depicted so far, I'll be using 16,480 as my short-term pivotal support. That means I'll be flipping to a short-term bullish bias for today on the Hong Kong 33. So this 16,480 is also the lower limit of this ascending channel that I drew from the low of 22nd of January. So first resistance to watch for sure will be at 16,890, followed by last week's minor swing high area at 17,230. Only an hourly close below 16,480 will invalidate these short-term bullish buyers to see another round of choppy corrective decline towards 16,135, which is so confluence with the 50-day moving average as well. Below it exposes the next support area at support level at 15,730. Japan 225 or the Nikkei 225. So the Nikkei 225 squeezed up in today's Asia session above the 20-day moving average, also in line with the very strong Japanese wage data as well. But what I could see over here is the hourly RSI now has really come close to a extreme overbought level. Okay, very close to the extreme overbought level over here. Okay, so indicating to us there may be limited upside right now, and also is also resting right exactly at this former ascending channel from the low of 8th of January that I drew earlier on. Okay, 4th of January, and if I do the Fibo retracement of this previous down move here, okay, it also correspond to the 61.8 Fibo retracement as well, the golden ratio. So with that, given such mixed element and with the hourly RSI coming close to extreme overbought level, I will be flipping to a neutrality stance for today on the Japan 225 39,640. Lower limit is 38,960 level. That means close to today's Asia session low. Okay. So neutral today for the Japan 225. European index, the German 30 going to remains bullish, higher high, higher low. So given the fact that it started to trace a higher high and a higher low on last Friday, I'll be having a tightened key short-term pivotal support level for today at 17,900 level. Okay, so this 7,900 level also confluence with the lower limit of this minor ascending channel that I drew from 14th of February low. So as long as 17,900 short-term pivotal support holds for today, maintain that short-term bullish bias on the German 30. First resistance level to watch 18,050/100, followed by 18,190. Only an hourly close below 17,900 will invalidate this short-term bullish bias to kickstart a minor corrective decline down leg. Next support level to watch 17,790. This level broken down exposes 17,650, which is also confluence with the upward sloping 20-day moving average. All right. Now, US indices, let us start with the Nasdaq 100. So Nasdaq 100, what we could see over here is that on last Friday, it broken down below the 20-day moving average. This is the daily chart of the Nasdaq 100, and also it also broke down below this parallel trend line support that I drew on the RSI over here. All right, this ascending trend line, it broke down as well, and prior it breaking down the last few sessions, it has that bearish divergence. So what we could see over here is that this Nasdaq 100 is actually at risk of shaping a multi-day to multi-week corrective decline, given this bearish element that's being depicted on the daily RSI, indicating to us that upside momentum is more or less eradicated. All right. And given the fact that last Friday we were neutral because of a mixed element and it broke down below the 20-day moving average, which was the lower neutrality limit at 17,960, we'll be flipping to a bearish bias right now for the Nasdaq 100. So given the fact that the RSI now has just to bounce up from the oversold level, so there could be a bit of mean reversion bounce up towards 17,960, maximum 18,110 level. So I'll be using this 18,110 level as my short-term pivotal resistance for today. As long as any bounce didn't surpass above 18,110 level, we'll be having that short-term bearish bias on the Nasdaq 100. First support level to watch 17,810 for today. A breakdown below it exposes the next near-term support level at 17,650. We also confluence with the upward sloping 50-day moving average. Only an hourly close back above 18,110 will invalidate the short-term bearish bias. That means this bounce has really been too steep, and we may see another round of choppy movement on the Nasdaq 100, with the next resistance to come in at 18,335 level, which is this, we call it, some people call it the minor double top range resistance, and above it exposes the next near-term resistance at 18,435 / 18,470. Nasdaq 100 done. US Wall Street 30, Dow Jones Industrial Average. So US Wall Street 30, it actually broke below the 20-day moving average, which is broken below that 38,840 short-term pivotal support level, and price action managed to stall at this lower limit of this minor ascending channel that I drew from 14th of February. So given that it managed to held above this ascending channels, minor ascending channel support, I'll be flipping to a neutrality stance today. That means neutral between 38,660 and 39,100 for sure. Why? Because this price action is very close. Last Friday, there's last Friday swing high, last Friday European session high. Before that sell-off took shape in the last Friday US session, very close below the 39,100. So which is also that former minor swing high area of 1st of March and 27th of February. So neutral between 39,100 and 38,660. Okay, now what's for gold price? Lastly, commodities. So let's flip to gold over here. Where's gold? Yeah, gold. So for spot gold, right? Right now it has been broken below the 21,503 level. So this level has been taken out on the downside. Okay, so this was last Friday short-term pivotal support, and the way it break down, and prior to that, it starts to form a lower higher over here. Okay, so with that, I'll be flipping to a short-term bearish bias for spot gold to see this minor corrective decline to play out after this steep run. Okay, after this very steep run from 28th of February all the way up to this 8th of March. All right, so right now we are in the motion of this minor corrective pullback. We in its short-term and medium-term uptrend phase that is still intact. Why? Because price action is still trading above the 20-day moving average and the 50-day moving average. All right, so next support level to watch out for will be 21.25, 21.10, using 21.80 as the short-term key resistance, pivotal resistance for today, to flip to a bearish bias for this potential minor corrective decline within a short and medium term uptrend phase to play out. All right, so as long as 2180 holds, short-term pivotal resistance holds, only a clearance above 2180, that means an hourly close above it, will invalidate this minor corrective decline scenario to see the continuation of this bullish impulsive up move, with the next intermediate resistance to come in at 2200 level / 2210 level. Above it sees the next resistance at 2220 / 2230. Okay, so that's for spot gold, flipping to a bearish bias given the breakdown of this 2153 level, and potentially right now we are undergoing a minor corrective decline phase, still within a short and medium term uptrend, with the next support level to watch at 2125, 2110. Okay, so with that, what's cooking for West Texas oil, WTI crude oil? Let me open up my chart. Okay, so for West Texas crude oil, no change. In fact, so still holding pretty much firm as price going to trace out a higher low right above the 79.70 short-term pivotal support that we have on last Friday. Okay, so I do not place it so tight at this level here, because this level has been taken out. Okay, so I will use this as something like a first support level for any potential pullback today, because it hasn't surpassed 81.65 yet, the first resistance. Unless it managed to surpass 81.65, then I will use 80.40 as my short-term pivotal support level. All right, so 79.70 short-term pivotal support level. Maintain that short-term bullish bias on West Texas oil. First resistance to watch 81.65. Above it exposes the next near-term resistance zone at 82.80 / 83.20. Only an hourly close below 79.70 will negate this short-term bullish tone to see a minor corrective extension pullback to retest the 200-day and the 20-day moving average, confluencing at the next support level at 78.40. Okay, so that's pretty sum up for the short-term technical outlook. All right, for today on the various cross asset classes. So now let us take a look at the calendar to share with you what are the key things to look out for today. Okay, so for today, right, other than the release of the China industrial and the retail sales figure, we do have a pretty much quiet session for today. We have the inflation rate. That's the final rate, finalized rate for February. So that shouldn't be a big surprise level. It should actually move in line as well with the with the previous preliminary figure. So throughout the US session will be pretty much quiet. So the action will only come tomorrow morning. So tomorrow morning, 8 a.m. we have consumer inflation expectation before RBA in Australia, 8 a.m. before RBA interest rate decision at 11:30 a.m. And Bank of Japan will have its announcement at 11 a.m. Singapore time, then followed by around 2:30 p.m. Singapore time. BOJ Yuda will give his public press conference. All right, and during the European session, then thereafter it'll be pretty much quiet already. Other than that, all right. So this will be the key economic data release to look out for early tomorrow morning Asia session time before the start of our daily dose at 11 a.m. So with that, thank you for your time and do have a great day ahead. And we shall speak again tomorrow. Thank you.